the other thing to remember is that we're going to be recording this lecture, so just so that you're aware. We're very privileged to have Mark Quaye and Simon Simon, sorry, who are going to
Simon Martin, you had it right first time.
Oh,
Sorry.
right, okay, I was right. It's the way the name switches round sometimes on these things. We're going to talk to us about the budget. Mark is from Marque Wealth Management, and Simon is from Technical Connections, and they're going to be speaking about the impact of the budget on inheritance planning. Mark's always been a great supporter of BACFI and has sponsored many of our events, for which we're very grateful. So I'll hand over to Mark, and then I presume you'll hand over to Simon.
Yeah, thanks, Ian. Yeah, thank you. So, as you say, I'm a great supporter of BACFI. Really enjoy working alongside, and we discussed, Ian, Gay and Sandra, what we could do this year to just bring a little bit of wealth management to the membership. And the subject of the budget, certainly, Simon and I thought would be really pertinent. So it's been well trailed, as we were just saying earlier, and it's a game changer, I think. The way that Rachel Reeves has set this out, it's causing people to scratch their heads and to think about how they're going to navigate through. So the key thing is making the point really that we need to take advice. And today is really about just setting the scene for you, perhaps things that you've read, things that you've heard, and Simon's just going to walk us through it. By all means, if you want to sort of raise a question as you go through, you see something that really exercises you, feel free to ask the question, but generally we'll probably pick up the questions right at the end. So without further ado, I hope you enjoy the session. I'm going to introduce Simon, and Simon will just give you a little bit of background to him before he launches into the slides.
Thank you, Mark, and good evening, everyone. And as Mark said, I'm Simon Martin. I'm from Technical Connection, which is a subgroup of St James's Place. We're a kind of technical consultancy company that work with advisors like Mark and his equivalents kind of up and down the country on a variety of topics, particularly around kind of taxation and around technical planning. The purpose really of this evening is to provide a broad kind of high level overview of the budget we've seen, focusing on three key areas. I'm going to look at what was announced pre-budget. We're going to look at what then did and didn't change. Really, really important not to miss what didn't change. Lots of rumours, lots of things that people were worried about didn't change. And then I'm going to touch on a few kind of high-level thoughts and opportunities and how we're going to structurally see planning differently as a consequence of the budget that we've seen. What I must stress, though, as a start is, as I said, this is really kind of generic planning. Hugely, hugely important that you should take on board your own position and say, well, what's actually applicable to me, and how does that kind of come together? And some of these things are also in terms of consultations, in terms of, for example, the pension and inheritance tax changes. The application of that legislation is going through a consultation, so there might be some changes in form, if not in structure. And so where do we start? For me, where we start is the quote that is put on the screen by the founder of the company that I work for, a chap called Tony Wickenden, and he talks a lot about advice alpha. That is the non-market dependent improvement in one's financial well-being as a consequence of taking advice. Now, this is split amongst a huge number of things, but it's really down to two or three key ones. The first one is behavioral coaching, for want of a better word. A big part of what Mark and his team do is help make sure that our clients make good, rational decisions, and that can be across a number of forms. So anyone who's been an investor or who has invested over the last few years will probably remember February 2020 when the COVID pandemic was in its infancy, and stock markets started getting a little bit worried about it. That's an understatement. And largely they went very, very quickly downhill. Now, the natural reaction to that would be panic, panic, panic. I don't like it. Get my money out of the market. That's a really bad thing. Help. I'm just going to go into cash because that feels safe. Now, that would have felt like a reasonable thing to do. But with the benefit of hindsight, that would have been the worst thing to do. The better thing.
Right, I think we've just lost you there, Simon. Just wait for Simon to come back. Oh, right, great, yeah. So you're just telling us about the. Yeah, you're back. You're back. So you were just telling us a little bit about
that. I don't know what happened.
The behavioural side, that people were acting irrationally.
Yeah, so the example I was using was the COVID pandemic, when the markets crashed very, very quickly, and it would have been a really, really sensible, would have felt like a very sensible thing to say, I don't like it, I'm taking my money out, I'm going to cash. When actually a better thing to do would have been to leave that money invested, because as we saw over the next 12 months or so, that recovery happened very quickly. Now, in fact, the best thing to have done would be the thing that would have felt most counterintuitive, which would be to invest more money, because you're effectively buying at a discount. So those kind of behavioral things are really important. So why is that? What's that got to do with the budget? What it's got to do with the budget is for us, the key thing is being really, really strategic about planning and saying, well, let's look at the budget in relation to me. Forget about, I'm not a farmer. The impact of farms largely has no impact upon me. What's the impact of me as an individual? What do I need to do? Mark, would you mind moving on to the next slide if it's still them? That's okay. And this is where the starting point for us is, before we get into the reads of what's changed and the tax rules and everything else, and we will, these kind of high level questions become even more important. Will you still reach your financial objectives following the changes that we've seen in the budget? Which of the changes will impact you? What does that mean? Second question, do you need to make any changes to your plan in order to mitigate the impact of that change? Or, interestingly, has the budget created any opportunities that you perhaps need to consider? Are there opportunities that you could think, oh, that is going to impact me and I might need to do something differently? Or I can make the most of that opportunity because I can do something that wasn't there before. So if we now move on to the next slide, we'll look at what we've seen in the budget and what some of the rumours were. So, we could talk for a long time about this, and we won't be fortunate to know, but there were a few very, very strong rumours that actually created some very strong reactions. If you read any of the press, there was a talk of, we're going to remove the tax-free cash, the pension commencement lump sum, to use its proper name, or we're going to reduce it down to £100,000. That was a really, really strong rumour. In fact, we had clients coming to us to say, I think they're going to get rid of it. I'm going to remove my tax-free cash. Now, hindsight would have proven that would have been an imprudent thing to do, because you're breaking money that you don't need into an environment where you don't really want it to be. We saw that, but that didn't come about. There was a lot of talk about pension tax relief. Now, pension tax relief, I won't be pleased to know, but I could talk for a long time about pension tax relief. It is one of the great opportunities for financial planning, the ability to effectively get tax back on money that you're investing. If you're a higher rate taxpayer and you want to invest £100, using a pension, it's only going to cost you 60. Plus a quarter of it is going to be tax-free at retirement, plus it grows in a tax-free environment. Pensions were very, very attractive, and pension tax relief, particularly where structured through employer contributions, are again very, very costly to the exchequer. So there's talk about that. My own view was that they weren't going to do that because it makes it very difficult for the public sector pension schemes. The public sector is very, very challenging if you had a flat rate relief for various technical reasons. There was talk about making pensions taxable if you die before 75. There was talk about inheritance tax being levied on pensions, which, as we'll see in a moment, we've seen. And there was also talk about a contribution coming from an employer, that being taxable through national insurance on the employer. So there was a big block of rumour around pensions. The reason for that, of course, I said, was that people save significant tax very legitimately through pensions. There was also a great deal of talk about capital gains tax. Were the capital gains tax going to increase? There was talk about a 39% tax rate, and there was talk of bringing them in line with income tax, which would have been a fairly straightforward political delivery, because you've always got the argument, you work and you pay tax up to 45, someone makes profit on an asset, they pay tax up to 20. That's a big discrepancy. It's not fair. It would always be in keeping with, if you've read much of around Rachel Reeves and her kind of economic outlook. She's a Keynesian economist, very, very keen on benefiting those who work compared to those who have assets. So for me, the budget's been big in lots of ways, but the direction of travel now has been very much towards that kind of economy now, and we'll see what that looks like over the coming years. One of the big advantages of capital gains tax is that any gains are written off when you die. Again, that was talked about being removed. We had lots and lots of conversations about inheritance tax. Now, we'll touch on inheritance tax quite a lot, because inheritance tax, in my opinion, is going to be a really, really big consideration for many, many people. So at the moment, the rule states that if you make a gift for inheritance tax, it will be exempt from inheritance tax after 7 years. And there was talk of extending that out to 10 years. There's also been a freeze on the inheritance tax nil rate band since 2009, and it's going to be frozen until 2028. So everyone has an inheritance tax nil rate band of £325,000. That's been frozen since 2009, a really, really long time. We've also have the residence nil rate band, which you can set against your property, of £175,000, and that's also due to be frozen until 2028, and the rumour was it might be extended past 2028, and we'll come back to that in a moment. There was also a conversation around business relief, that is the relief that exempts a trading business from inheritance tax. Agricultural relief, the same structure but for farms. And AIM, the unquoted markets, which are also inheritance tax exempt. So there was a lot of conversation around that. The other one we've seen, which is the big tax rise that no one has talked about, or very few people have talked about, which is the freeze on all of the income tax rates until 2028. Now, this was a very, very clever, in my opinion, piece of legislation, because what they've done is said, and this was originally a Conservative Party policy that's been continued, what they've said is, we're going to freeze all the income tax thresholds until 2028. So the personal allowance, the higher rate threshold, the additional rate threshold, the £100,000 where you lose your personal allowance, all of those thresholds are going to be frozen until 2028. And one of the rumours was that freeze might be extended. Now, make no mistake, that is a tax change that's going to cost, or going to make, depending on which way you look at it, make the Chancellor tens of billions of additional revenue every year. That is a very, very effective piece of tax planning, particularly the environment that we live in, where we've seen over the last couple of years some pretty heavy inflation. Notwithstanding, I appreciate there are some on the call, I'm sure, who can remember greater inflation, but 10 and 11% is as high as it's been probably since about the early 1980s. The corresponding tax and salary rises and things that have come through have meant that far more people are pushing through the income tax bands. It creates fiscal drag, which creates a significant tax revenue. So the question is, would they extend that past 2028? The short answer is no, fortunately, but that's on the cards. And there's also, were they increasing the national insurance contributions for employers? Anyone who deals with private equity employees or investors, depending how you look at them, they had a particularly generous tax regime where their bonuses, if you call them that, or profits from their own funds, were taxed at capital, and it was widely rumoured that they were going to be looked at in a less efficient way. So yeah, we saw lots of potential rumours, lots of things that could have changed, and all of those created a bit of a kind of scurry around. What should I do? Should I do something now? Should I sell my business? Should I make a large pension contribution? Should I take my tax-free cash? And our advice to clients at that point was, be really measured and really prudent. Don't do anything based on rumour, because what you don't want to do is get caught out, and that could happen. And so there was lots of rumour flying around. And as I said, our advice was, keep on track. There may be one or two occasions where you might want to do something pre the budget. For example, if you had a large share portfolio, you're planning to sell it in the next couple of months, you may want to sell it before the budget. But by and large, our advice was, let's wait and see. Don't act on rumour, and we'll make a sensible decision once we got all the facts. And so we'll look at a moment about what did change, but what didn't change for me was equally important, because the UK's tax system has lots of legitimate planning opportunities that we've got. So, for example, pension tax relief, the ability to get up to 45% tax relief on your pension contribution, is incredibly interactive. Notwithstanding the changes to pension death benefits and the assessment to inheritance tax post 2027, using pension tax relief remains the most efficient way for most people to fund their retirement. You might use your pension differently, but funding it makes a lot of sense. PCLS, tax-free cash pension commencement lump sum, remains unchanged. The legislation means you can still take the tax-free cash that you would have done pre the budget. Those two things are very, very positive. Things like ISAs, junior ISAs, remain unchanged, still there, important part of financial planning, utilising reliefs, utilising exemptions. The fear around employer national insurance was on pension contributions was rebuffed, which was very, very positive. Interestingly, it was interesting to me, maybe not you, but the capital gains tax rates for higher rate taxpayers selling property was retained at the lower rate of 24%. Interesting. I thought that would go up a little bit, but that's an interesting opportunity. And the capital gains write-off on death was also removed. And what we didn't see was an extension of the income tax freeze. So what that means, as it stands at the moment, is the income tax freeze will end in 2028, and we'll start to see the tax thresholds rise again. Notwithstanding that, there'll be a big fiscal drag between now and then. It is a positive market. So whilst there are some significant tax changes we'll look at in a moment, whilst there are going to be undoubtedly tax raises for some, particularly small businesses, there's lots of planning opportunities that still remain, lots of things that we can still do to maximize our position, but also crucially, back to where we started, make sure we can still reach our financial goals. So let's have a look at what did change. You didn't come here to listen to what didn't change. Let's look at what we saw. So we saw some very, very significant changes in the pension, the world. The biggest of which being the plan at the moment is for pensions, these defined contributions, so not final salary, but defined contributions, so your pension pot. The plan is for it to be, or the legislation is for it to be liable to inheritance tax in 2027. Now, there is a consultation being launched, but that consultation is focused more on the application of that rather than specifically what it's going to look like. So, as I said, it's very, very early days, but it's but for us, for our business, for our clients, this is a very, very marked difference. Prior to 2027, pensions were starting to be used in a way that were not quite perhaps what they were used for, and hence the change in legislation. Because if you think about the tax journey of a pound going through a pension, you get tax relief going in, so you get topped up by the government going in. You don't pay, you put next to no tax inside the fund, and you can draw a quarter of it tax free. And if you don't draw it all, it's free of inheritance tax on death. It really does tick every box. It was almost too good to be true. So they've adjusted that, and they said, we're now going to make pensions liable to inheritance tax from 2027. So does that mean pensions become useless? Absolutely not. Pensions, in my view, are still the best way to fund your retirement because of the upfront tax relief that you get in making that contribution. What it will do, though, and we'll come on to this in a moment, is it will significantly change what we call decumulation. So when you get to retirement, the default advice for most people is, where you can possibly afford it, don't take your pension in retirement, even though that would feel logical. Leave it alone because it's free of inheritance tax. Spend your other assets first. We'll start to see that being reversed over the next couple of years. We'll start to see that. As I said, there's a consultation being launched to look at the application of that tax, how it specifically comes, but it will fundamentally change how we draw retirement income for most of our clients. The other thing that is likely to be there, or so it seems will be there, is pensions will be liable to inheritance tax on death, and then if you die after 75, the income will also be taxable. So that feels a bit double taxy to me, but we'll see what that looks like. Again, if that does end up being the case, I think what we'll start to see more and more of people drawing money in lifetime, gifting it, putting it into trust, doing planning with it in lifetime rather than leaving it till death. Any of which can be done. We can do that in a very efficient manner, but it just, again, changes what we're doing. The capital gains tax changes. So we've seen higher rate taxpayers selling shares. The rate's gone up from 20% to 24%. Basic rate taxpayers under the same basis go from 10% to 18%. Now, there's some very clever marketing here that says, oh, it's gone up 8%. It hasn't. It's actually gone up 8 percentage points. It's gone up 80%. The capital gains tax rate is pretty significant. Onto IHT, onto inheritance tax. Now, inheritance tax, we talked about the freeze a few moments ago. That freeze is being extended from 2028 until 2030. That means there'll be 21 years of £325,000 nil rate band. This for us is, alongside pensions, going to be the biggest change. Many more people will be caught by the inheritance tax net, in our opinion. Not only are they freezing the band, if you can imagine, assets typically rise in value over time. The band stays the same. Far more of the assets will end up being liable to inheritance tax. And we've got the added implication of your pension now being part of that net. So for us, we're looking at thinking this is going to be a very significant change. Inheritance tax planning, I think, will become pretty default planning for many people. Whereas once upon a time, inheritance tax planning was for the very rich. Now I think more and more of kind of middle asset owners will really have to start thinking about it. The other thing that we've seen, which is going to be quite interesting, is the business relief and agricultural relief. Now they're the reliefs, and forgive me if you already know this, that effectively reduce the inheritance tax value of an asset to nil. So trading businesses and farms, most typically, used to be fully exempt, or were historically fully exempt from inheritance tax. The budget announced that each person will have £1 million. The first million of business relief and agricultural relief will be exempt. The rest will get 50% business relief, which effectively means they'll be inheritance tax liable at 20%, or you'll half the value at 40%, whichever way you decide to cut it. It works out the same. That's a big impact. As I said, I was in Wiltshire today talking about this, and lots of farmers there. And this is one that's really kind of riled people. So farms, obviously, for obvious reasons, but also businesses. A business of 1 million doesn't take much before you then start to think about inheritance tax once you've got it above that. Historically, that was always going to be exempt. That exemption now has halved for the large part above 1 million, and therefore thinking about getting ahead of myself in terms of planning we're going to talk about, but thinking about gifting businesses in lifetime becomes a consideration in a way that wasn't there before. Things like unlisted shares and AIM, the alternative investment markets, they used to be fully exempt. Now they're only exempt to 50%. So all of those things together, the freeze, the pensions, the farms and the businesses, are really going to open up this consideration, really going to open up the inheritance tax threshold to people. So thinking super carefully about how you draw that money and how you draw your retirement income is going to be greater than ever. We've also seen some impact on employers. So you've probably seen employer national insurance has gone up in two ways. The rate has gone up from 13.8% to 15%, and the payment threshold, which is where you start to pay it, has come down from 9,100 to 5,000. Now, in many ways, there's not really a lot you can do about this if you're a business owner, because they are the rules, but I think it will drive people to think about, for me, I think, what's the inflationary impact of that going to be? Particularly when married with the increase in national minimum wage. All of those things are going to create an additional cost for an employer. Everyone's going to be jumped up all the way through the threshold, because you can't jump up one group without the other. That will come through in pricing, that will come through in lots of things. So it'd be interesting to see, but I wonder if that might be slightly inflationary and have a knock-on effect then on potential planned reduction in interest rates. Maybe we'll see. Lots of change for domiciles. Non-domiciles, really big change. Moving to a residence-based arrangement. We won't go into too much detail, but if you're a non-domicile, it's really important to seek advice to make sure you're not going to get caught out by any of the changes. What else have we seen? Well, we've seen a lot around property. Property has always been a big one. So stamp duty, the surcharge, which is where someone is buying a second property or buying a property through a trust or a company. There was always a 3% stamp duty land tax surcharge. That's increased to 5%, 5% on top of the normal stamp duty rates. Really significant. That's going to catch or make purchasing second properties very unattractive for many people. Really, that's continuing the push, which has been around for a few years, which is we want purchase of property to be people who live there, not buy-to-let landlords. We've also seen a confirmation of the changes around furnished holiday lets. Now, furnished holiday lets, think kind of Airbnb type arrangements. They used to, or historically, got some nice tax benefits. You could get business asset disposal relief and sell them at a low tax rate. You're allowed to fully offset expenses. You can make pension contributions. There's all sorts of allowances. That's all been cut now. Furnished holiday lets are treated precisely the same as any other buy-to-let. We've seen business asset disposal relief being scaled down. Business asset disposal relief, as was entrepreneurs relief, allowed you to sell the first million of your business at 10%. It used to be the first 10 million up until 2020. Then it got scaled back to 1 million at 10%. As of April next year, it's going to be 1 million at 14%. And then April 2026, 1 million at 18%. So gradually that's being less and less attractive for business owners. And as we talked about carried interest with people who are working in private equity, their tax on their bonuses, it's still being treated as capital, which I think is probably to be quite pleased with, but the tax rate has gone from 28 to 32. So we've seen lots and lots of changes, lots and lots of things. For me, it's a totally different breakdown of how the government's starting to tax, how they look at where the bulk of the tax revenue should come from. The two starting points are completely individual. So this will be totally different for absolutely everybody, which is the need for advice is greater than ever. Things which were simple before, leave your pension alone, it's inheritance tax free, is now more complicated. How do I create a retirement income in a way which is inheritance tax efficient is a really big question, and one that we're going to be asking of every client, or answering for every client perhaps, as we look at their income structuring. Second one is, does your plan work? What are your financial objectives? Where are you looking to get to? If I was saying to Mark, I want to retire at 60 and I want £40,000 a year income, we could sit down together and say, well, let's have a look at the particular things in the budget that are going to impact you. Let's look at whether your plan is still on track. Do you need to do anything? Do you need to make any changes in order to do it? It's really easy to get up in arms about things that don't impact you. You know, it's important here just to say, well, let's first of all look at what's the impact on you. Do you need to do anything differently? How are you now standing? That said, there are some potential ideas. These are the kind of things that clients may want to be thinking about over the coming years, particularly post 2027. With pensions, as I said, there's a consultation. So leave it well alone until the consultation's finished, because that's going to be a really, really important part of it. But some general thoughts and planning measures. You know, drawing income from pensions will become more attractive than it ever was before. If the pension is liable to inheritance tax, drawing income in the basic rate, 20%, to save, and gifting to save 40% inheritance tax becomes very, very attractive for obvious reasons. Potentially, if you're going to get hit with a double tax, you may want to draw your 40% band to get more out, because you're paying 40 to save 67. Again, that's very individual, but it's really worth thinking about. One of the most underused, but I think useful inheritance tax exemptions is the gifts from income exemption, which where you can give away surplus income and it's immediately inheritance tax free. This has remained in the budget, which is fantastic news, because I think over the coming years we're going to see more people drawing pension from their income from their pension and gifting it away. Maybe taking annuities. Annuities is where you take your pot of money, you give it to an insurance company, and they will guarantee you an income for life. The advantage of that, of course, is you've used an asset that would have otherwise been liable to inheritance tax, and you've created a guaranteed income stream. Now, what good does that do you? Well, first of all, it gives you an income stream, obviously, but it also gives you some opportunities. It gives you the opportunity to take that income stream and buy a whole of life insurance policy. When you die, that money is recycled back into your insurance policy, gives you a large cash payout, and you've effectively used that exemption to recycle your income from an asset which was liable to inheritance tax into an asset, the trust, which is not liable to inheritance tax for you. So it's a great way of recycling taxable money into non-taxable money. Again, it's a little bit complicated, but lots of opportunities. Opportunities for taking pension income you don't need and gifting it. Again, using the gift from income exemption. We're thinking around, you know, if you can pay 20% tax on your income, on your pension income, and you gift it to your children, adult children, that is, you perhaps pay higher rate tax. You can pay 20, you pay 20, they get 40% tax relief. You're recycling it to someone else's name while getting more tax relief than you're losing in tax. Lots of interesting planning, very individual, but lots of opportunities. The pension commencement lump sum tax-free cash, as is colloquially known, has remained, which is fantastic. I think we'll see a scenario where many people draw their tax-free cash and do some inheritance tax planning with that money, because it can be drawn out tax-free. Lots to think about. Capital gains tax, investments that are liable to capital gains tax are still quite attractive. The write-off on death is important, and the rates are lower than income tax, which again is important. Business asset disposal relief. If one of our business owner clients were looking to sell in the next few years or next year or so, perhaps bring that forward, try and get the lower rate if at all possible, and if that fits in with objectives. So there's, you know, a few things to think about there. As I said before, inheritance tax is such a big consideration now for people. As I said, we talked about the freeze. That's going to be really significant as assets typically rise. Pensions are brought into it. Lots to think about. So a key piece of advice is worth thinking about, you know, for you, and even, you know, up or even down generations. What does it mean? What does that mean? You know, if you're as I am in my early 40s, looking up the generation to say, well, what does it mean for the generation above? How is that pension impact going to impact? Because ultimately, you know, let's be frank, the person who pays inheritance tax is the recipient, not the deceased. So, you know, we encourage our clients to look up and down the generations. Will you be impacted by assets going up, going down? What does that look like? Using the tax-free cash to create inheritance tax efficient income. We excuse all the acronyms. We've got a trust that you can make gifts into, inheritance tax free in 7 years, and you can still receive an income from. Those kind of planning ideas, I think, are going to be really, really interesting. The use of trusts, as I said, the use of whole of life insurance policies to take income that you don't need, take surplus income, and use it to fund the policy that will create a tax-free lump sum on your death. So lots and lots to think about. A couple of other things over the next page that we want to start thinking about for clients as well. You know, for our business owner clients, what we've seen is those two things, that, you know, the remuneration structure, how you pay yourself might change as a consequence of the change in employers' national insurance. I think we'll see a big jump in freelancers rather than employees. I wonder if we'll see another push towards automation. Not really a financial planning question, but if as staff get more expensive, would that encourage people to look at automation? Pensions still are tremendous ways to fund retirement. As I said, upfront tax relief, very, very attractive. I think we're also going to start to see, both for businesses and farms, a lot of lifetime gifting. If you own, or if you know people who've got a large business, being able to gift that large business in lifetime will be very, very attractive. Now, they've retained the gift holdover relief. That means that the donor, the person making the gift, can pass the gain on to the recipient, much like where a husband and wife or civil partners gift assets, kind of no loss, no gain scenario. So I think we'll start to see a lot more of that, utilizing that 1 million business relief or agricultural relief limit. And there's also where the assets go on first death. Our reading of the initial change is that the allowance, that million, is not going to be transferable between spouses. So utilizing it on first death, really, really important. As I said, this is, you know, first thoughts, high level stuff, but there's going to be some really, really fundamental changes. Of course, domicile, if you are a non-domiciled individual, important to seek specific legal advice from someone that specializes in domicile. And then linked to all this is, you know, what else might happen. The key thing as a starting point is, as I said earlier, we've got lots of allowances, lots of exemptions that are going to be still available to us, making sure they're utilised. Could they be taken away in the future? Who knows? My worry about all these things is they create a batch of measures that will say we'll earn, I don't make a number up, £70 billion rather. But naturally, tax changes result in people's behaviour changing. So people will, you know, the things we talked about today, people will make behaviour changes. I'll do this differently, I'll do that differently, I'll draw money here, I'll gift, I'll do things I wouldn't otherwise have done. And therefore they don't quite make the amount of money they would hope for. And if that money's already been spent or earmarked, then do they come again and say, okay, we now need to think about secondary measures because we didn't quite get what we thought we'd get. Now, of course, that is naturally just speculation, but the key thing at the moment is, as I said, use allowances, use exemptions, review your situation regularly, and make sure you're still on track. That's the most important thing here. What's important to you? What's the impact for you? How does it impact what you will or won't do as a consequence? So all in all, we've seen, as I said, some very, very significant changes. For me, the biggest changes are going to be around businesses, the cost of the staffing and the potential inflationary impact. But the one from a personal financial planning perspective is going to be inheritance tax. Pensions coming into inheritance tax. The change to businesses and farms, and the freeze until 2030. Inheritance tax is going to be a really, really important one. So overall, taking advice, hugely important. Make sure, you know, that, you know, is there anything that you need to do differently as a consequence? Do you need to make any fundamental changes? And that's exactly why Mark and his team are here. That's what they do. That's what they've been doing for clients for years and years and years, and will continue to do so, whether it's this budget changes or another one, or we get a new government in 5 years' time and things go back, or whatever it might be. You know, that regular review is super important. So all that leaves me to say is thank you very much for your invite. I hope there was something you could take away. We're now going to see if there's any questions. if not, we'll let it go. So thank you very much. And I don't know if you've got anything to add, Mark, as a close.
Yeah, no, thank you. That's really well done. Yeah, what a challenge to fit it in 45 minutes. And it was not too heavy because behind all those little one-liners there's a lot of content, a lot of complications. So as Simon said, it's just key to take advice, and I'm going to follow this up as well. We're going to have a little bit of question time. There was a little wobble there on the sound when you talked about gifting from normal income into grandchildren's pensions, and could you just go through that little bit again, just so that we understand that arbitrage between 40%?
Absolutely. I think the fact I've got 3 nearly teenage boys trying to steal all the Wi-Fi is actually the problem, unfortunately. But hopefully you can hear me the second time around. Yeah, so let's assume we've got, I don't know, for example, we have a client who is taking out income from their pension because they're worried about inheritance tax. They don't really need the money. They take that money out and they pay basic rate tax. They take basic rate income from that pension. They can gift that pension proceeds minus tax to their children. And if their children are higher rate taxpayers, their children can put that into their own pension and they get 40% tax relief. So you've got a bit of a tax arbitrage as the 40 is greater than the 20, plus you've got the money out of the pension, which is now liable to inheritance tax. So you've got an inheritance tax advantage in doing that as well. So yeah, it's a nice idea, I think, for those people who can take pension income in the basic rate and have higher or additional rate tax paying adult children who could, benefit from their own pension funding.
Great. Thanks for clarifying. Sorry, don't want to hog the time now. Any questions? It's a lot to take in. So this is recorded. So what we will do, Rebecca and I, we'll send a little email to you, Gaynor and Ian, and all the attendees. We would love the opportunity of just having half an hour, either over Zoom or telephone call, just to sort of pick out your questions that you may have. Sometimes people just want a quick audit on their affairs, and that's what Simon was alluding to. It's timely to do that, but we'll do that. You're in your own schedule and your own timing, whatever's convenient for you. But thanks ever so much, Ian. Thanks ever so much, Gaynor.
Simon and Mark, thank you very much. Yeah, this budget certainly has caused a few heads to scratch, if that makes sense, because of the changes in inheritance tax in particular. So I know farmers are up in arms about it as well. So it'll be interesting to see how it all pans out in the future. So I'm sure a lot of people have got to start doing tax planning, but I would imagine it's almost too early until everyone's worked out how the budget sort of effectively is executed after, because there's sometimes consultations, as you've mentioned, and legislation to be put into effect.
Yeah, certainly the pension one in 2027. I think it's the consultation will be middle end of Jan next year. And you're right, a measured vote. Once we know exactly where it's going, I think we don't rush into doing anything in a panic. Let's wait until it looks like we have got a bit of time regarding that.
Yeah, the thing is, they're not going to reverse it. So I think that we know the direction of travel.
Yes.
So I think, doing the different models, we have a modeling system which allows us to annuitize as well. Look at how an annuity can impact a cash flow. So we build a cash flow for you, a lifetime cash flow. It's all theoretical, nothing we need to sort of react to, as we just said. But if you can model a drawdown or decumulating pension and an annuity and all the things that Simon mentioned, it suddenly puts you on the front foot come 2027. So yeah, nothing to panic about, but certainly things to do.
Yes. Does anybody have any questions? Otherwise, Mark and Simon will take them directly and arrange sort of, as you said, a half-hour kind of appointment for some initial thoughts, I would imagine.
Yeah, absolutely gratis, absolutely free. It's all part for the service of the membership. So I always feel that we will do that for you.
Thank you, Mark.
Great.
Great.
Thank you.
So we'll see you at the Denning lecture.
Yes, well, I was going to remind everyone the next event is the Denning Lecture on the 3rd of December, and we've got Dame Geraldine Andrews speaking about affording justice. And again, that's sponsored by Marque Wealth Management and LexisNexis. I think that's one of the big issues is funding litigation. As we've seen with the post office case, it didn't really take any traction until they were able to get funding to take their case. So I think that will be a very interesting talk to see what Dame Geraldine has to say. Gaynor, do you want to say anything before we close this evening?
No, I think it's all been said, and hopefully people will take up the kind offer of a chat with Mark and Simon and team. I think it would be well worth it.
Thanks, Gaynor.
Well, I'll let everyone get back to their gin and tonics or whatever. And
if only.
yes. And thanks again, Mark and Simon.